We have Mike Bristow joining. Marvelous.
Hello, everyone.
Mike, I cannot believe after all these years. How are you?
Very good. Very good. How are you?
Hello.
I'm a bit embered out.
I remember those days. Yes.
Yeah. So we can I say where we met, or is that?
Yes, go for it.
Well, if we don't say where we met now, it will only leave imagination. So let's be clear. So we met at the Simon Zushi Mastermind Program, which was a one year mentoring program for property. Now tell me, was that year more difficult than the MBA, or was the MBA more difficult than the mentoring program? That's what I really want.
No, the MBA. I was doing the EMBA in 07, 08. And I was working as a strategy consultant on big private equity due diligence projects, and literally I would take a longer route in to work on a single bus so I could fit in some case studies for Zhao, and then it was sort of the time when my taxi ride home at 2 a.m. Would be a material portion of my sleep. So I mean, it was pretty full on. That's the challenges of the EMBA, right?
Yeah, like the pie chart of tiredness to it's amazing how productive and exhaustive this sort of natural flux between the two.
Yeah, definitely. But it's great. I look back fondly at those days. I mean, the human species keeps growing because parents forget the hell of the first child. They remember all the wonderful bits and keep reproducing. So I think in many ways there are very fond memories of LBS, and I try and put the chaos in the annals of my brain.
Yeah, it's good. It's such an adventure. Have you had the pleasure of meeting Chris? Mr. Tingle before? Have you had the pleasure of meeting Mike Bristow?
We haven't had a chance to meet, but very good to meet you.
Nice to meet you as well. No, I have not. Are you in the United States, or where are you? Where are you presently?
I'm in London, and yeah, it's firmly locked down. How about yourself?
I'm in the United States presently, Florida. Last year I was in Dubai. I had planned to be in Argentina, but because of the lockdown, I'm still here in the United States.
Are the bars behind you in the window to sort of emphasize that you are in lockdown?
That's probably a good point. But I'm in the sunken living room, and that's the wet bar behind me. So, yes.
Sunken living room. Isn't that interesting how you have different appetites for layouts and floor plans depending on culture? So much in the programs we talk about how culture affects everything that we do, but it's interesting how some people prefer open plan, some people prefer a separate kitchen. It's just very interesting.
And those things change when schools are not on.
Indeed.
Yes. Yeah. What sort of cupboards this high that are lockable?
Yeah, exactly.
How is Florida then at the moment?
So let's see. With respect to the pandemic, it should be very frightening, but people are behaving like there's nothing going on. For one of our business industries, we have multiple facilities. It's a very difficult time because we're in the senior care, and we were taking extraordinary precautions, and we had no loss of life. And then the governor required all the facilities to be open to the public, and hospice, of course, goes into all the facilities. And then we had COVID run through our facilities, and now we had a reduction of about 35% of our head count because people got sick and died. And once someone got sick in the facility, there was no way of containing it. So they, now we're in the process of building back up, and thankfully, I thought this month or next month February or March would be our undoing. We've been in this business 21 years and have never had a loss of income. We've always been in the black. we're still in the black, but not by much. One hiccup, or we have revenue, we have resources, but so on that front for that particular business, it's dicey. I'm also a real estate attorney, and that market segment is doing well. In Florida, real estate's almost always going to do well. The Great Recession notwithstanding, the global financial crisis. And yourself, where are you, and what do you specialize?
Oh, me?
Yes.
Oh, yes. Well, I'm a nutritional therapist on Harley Street. I have my own company, an entrepreneur like you. And I'm doing the EMBA because I'd like to scale health and systemize it so it can be more affordable for many. And it's it's a pleasure I'd like to introduce to MJ actually, because MJ saw it and I actually started the Facul-Tea initiative. And MJ, you are a heart surgeon in Kuwait, and your hospital has been taken over by COVID patients. Maybe you'd like to share on that.
Yeah. Our hospital was the newest hospital that was added to the healthcare system in Kuwait. And we were slowly trying to go to 100% capacity. So when COVID started and there was the talk about, pandemic and spreading and whatnot, the government thought that because this hospital wasn't fully occupied, it was the easiest to empty out. And hence our hospital was taken to become the main campus for all COVID patients. So anyone who was diagnosed got transferred to my hospital. And I guess the people who suffered the most are the surgeons, because intensive care, operating room, all resources were resourced or rerouted to look after the COVID patients. And we're still at it. The numbers are stable. They're not exploding yet. But the situation is so fluid that no one can say whether things are going to stay okay, take a turn to the worse. But they're trying to vaccinate as many people as possible. Unfortunately, people are, I should say, reluctant to take the vaccine. They're weary about their DNA and fertility and all these rumors that are spreading around, and hence people are reluctant to take the vaccine. The government is spearheading like a huge media campaign with social media influencers, famous doctors, famous personalities, government and parliament heads, all vaccinating online or on air to calm people down and encourage them to vaccinate.
Great. Pooja and also the professor. Welcome.
Hi, Suresh. Hello, everyone.
Hello. Hello, everyone.
Pooja, hello, Professor.
Hello.
Pooja, nice to see you. This is exciting.
And Karina also just joined. I can see her.
So good to see everybody on a single platform in this video.
Ramsey.
What made you choose the Louvre as your background, Pooja? Just out of interest.
I was just browsing through just to get a cool background, and I just got it. I don't even know where it is and what it is. So
It's perfect. Real estate architecture, it's perfect. Suits.
I know.
And Professor, do I see, is that New York?
Hi all.
Yeah, that's New York. But I'm not in New York.
Oh, gosh.
Hello, sir. How are you?
I'm doing well. I'm doing well. How are you?
Good to see you.
Yeah, yeah.
Nice meeting you all.
Great.
Now, is anyone here who actually signed up to the first version of this event? Because it's nice to see that that you're nice, fit, healthy, and well. So I'm just happy to have you here.
Thank you very much.
Hi, Dottie.
Dottie is also there.
Hi, hold on 1 second.
Sorry, I'll draw attention away from you. Hi, Enrico.
Okay, you got this walk.
Hi.
Perfect. Perfect.
Hi, keep it just, you know.
This is not. I just have to turn the article. I have
Take your time, no problem.
get out.
Very. We have Firas here. Hi, Firas. Firas is developing this new cool idea. I wish we could share it, but I don't know if it's top secret still.
Oh, now I disconnected him. Yeah, this is all wrong. You can't.
Hello, Stephanie.
Hi, Firas. I love your font. It looks really good on you. So tell me about your the app that you're developing.
Oh, no, it's gone now.
Yeah, well, it's not really top secret,
Never
and
go right, unless you get a different screen. See, mine's not right.
Dottie, maybe you can allow that rotating feature.
No. Let's all. No,
We fixed it last time. We were on. I showed you how to move it.
all have to move.
Okay. Well, now it's gonna have to.
Pull it up.
Yeah. Okay. It's so sad now.
Well, I don't know how to enable the rotate function, which is what I'm being told by my technical mate. So I would just do that, but I don't know if that's too innovative or basic. I'm not sure. But we can run a poll. Covered how to do.
I don't know.
She just said something that she has to do the rotation thing.
Oh, okay.
She didn't know how to do it.
All right, don't worry about it. I don't.
No. So is anyone aware how to do the rotation feature on Zoom? Anyone? Or you rotate the phone? Yes, okay. Right, thank you. Good tips. Yes, we either use the rotation function of it. Give me better lines here. Right, thank you. Yes. Would you consider moving the device itself? Or is that?
I did. I don't know.
She's saying you have to
No,
rotate it up.
I know. That's, yeah, but it's still not right.
I know it's makeshift, but it's COVID. So
Yeah.
I can roll with it.
I think
Right.
the software feature she needs to enable.
Well, whatever.
Okay.
You'll just have to.
Perfect.
Let's do that in a tutorial after. So Dottie, this is Pooja.
Hi, Pooja. Great to be here.
Great to see you as well. I think this is fine. Don't just bother too much about your screen.
I am
You're able
away
to
at
see
the
you, you're
moment.
able
I'm
to
not
see us,
in New
which is
York.
perfect.
Yeah, I'm sorry. I'm not in New York City at the moment. I'm away, so I don't have any of my normal stuff around me. So this has been kind of impromptu, but I wanted to be here.
We are glad you're with us as well. So I think we are 5 minutes past the time, or shall we wait a bit more?
No, we crack on.
Okay. All right. So thank you everyone for joining today, and welcome to the Emerging Real Estate Trends in the Aftermath of Coronavirus. This event is brought to you by the MIF Telegram group and was organized by Mario I from the EMBA LG 2021, eClub, and Suresh MJ Steph, which you see on your screen, from Facul-Tea, and sponsored by Ahmed T. I am Pooja Singh.
And I'm Stephanie Webster. And today we are going to be hosting this event. This event will be recorded and all discussions are held under the Chatham House rules. We are not qualified to give financial advice. And if you require any advice of any kind, you should seek a suitable licensed professional. The content of this event is for informational and strictly entertainment purposes only. Whew. So today we'll be talking about the pandemic and the state of real estate wherever you are in the world, in the context of the pandemic. So our speakers have expertise in the UK, in Middle East, Southeast Asia, UK markets, and we will seek to answer which type of commercial real estate assets are the best for income generation today? Or will it be residential, or will it be office, or will it be industrial? What is the best asset class within the real estate market that generates the highest yields?
And then we will see which investment strategies are likely to produce the highest yields for investors, and discuss current financing options, including how to structure Sharia compliant investments. We are honored to have such a dynamic and diverse lineup of speakers today. Thank you all for investing your time for the LBS community.
Yeah, I agree. So thank you to the audience for taking the time, and thank you very much to the wonderful speakers that we have. And I'll start with Professor. How are you this evening?
Hello, Stephanie. It's very good. Thank you. It's really a pleasure to be here and to participate in this event, and congratulations on putting it together.
Thank you so much for making the time. Your reputation comes before you, as you're currently teaching corporate finance and the real estate finance elective at London School. And the outbreak of COVID-19 has acted as a massive restraint on the real estate market in 2020 with government guidelines and social distancing. And despite this, the statistic I have here is that the global real estate market is expected to grow. Sorry, do we have a poll on this actually? The global real estate market is expected to grow at a compound annual growth rate of 8% and reach almost $4,000 billion in 2025. Does anybody believe that? I mean, is anyone feeling particularly flush? Do we think it's going to happen? Do we not know? What do we think? So we can all have a little vote and have a little. But whilst the answers are coming in, Professor, is this true?
It's a good question. I mean, certainly some real estate markets have been more resilient. Some segments of real estate markets have been more resilient than others. But let me start by maybe stating the obvious. Real estate assets are valuable because they provide space, space that individuals, businesses would like to use, and they are willing and able to pay for their use. We are all using space. All of us in this room. So the question is, how will households and businesses will relate to the space in the future? Okay, and so that's an important question. Okay, second part of the question is about the ability to pay for that space. Okay? Will businesses, will households be able to pay for that space? That's the second broad. I'm sure that we'll discuss this in more detail, but that's the second broad line of thought that I would like to bring to the debate. And the third is the role of the governments. Okay? In there are several dimensions in providing support for businesses and to families, in providing supports for economies through interest rates reductions, through quantitative easing. So those three aspects people need to have them in mind because they are very important when we think about the real estate markets. But it's also important to think about the different segments. Which segments are we going to see being successful going forward versus which segments of the real estate markets we will not see as being as successful, because our relationship with space has changed and will change in the future further. And I'll just leave these introductory thoughts to start off with, and maybe pass it to some of the other panelists.
Absolutely, well, that's very interesting. The affordability point struck me in particular. Oh, we have the results. Yes, what an optimistic bunch we have. But no, we still have, okay, it's quite interesting, very interesting. Next, we have a look at the US. Dottie Herman is a self-made titan, CEO of Douglas Elliman Real Estate, overseeing 7,000 agents across the US, generating 27.8 billion in sales last year alone. So Dottie, what's happening in the US and what is your strategy this year, given the affordability point that Professor has just brought up, actually?
Yeah, it's quite interesting. I will tell you that obviously in the US, we were shut down, at least in New York City, and New York City probably is where we Douglas Elliman earns the most revenue and the most vibrant, and we were basically shut down. So therefore, everything just stopped. And people were afraid of the virus. And on top of the virus, what happened to New York City was they let the jails out, they let all the homeless shelters out, and it became very unsafe. So people now were fleeing, one, because of the virus, and two, because of safety issues, which we really, New York was the safest city, one of the safest cities in the US, big cities. And P.S., aside from New York City, the rest of the suburbs, any suburbs that was around the big city, whether it was LA, whether it was suburbs of LA or San Francisco or New York, those did like unbelievable. And this year through 2021, across the country, nationally, we expect it to be the best real estate year, the most transactions since 2006. And
why?
This is in residential. Because what happened is when people were forced to shut down and they initially then stayed in their place, they wanted then space and they wanted to be safe. So that was the first reason, that they first rented, but then they felt, we should do this. Then when everyone got used to working at home, and as we all know, probably Zoom and virtual meetings will stay even after. What's happened is that people don't have to be in the office every single day. And after the virus, that will continue as a trend. So when you don't have to be in the office every day, then you don't have to commute and you don't have to do public transportation. So you can live further from a city.
Interesting.
So that's what you're seeing. The residential across the board, other than what was hit like a big city like New York City, is like booming, unbelievable. There's no inventory. It's probably one of the lowest amounts of inventory, and prices are, we project again, another 5% this year up.
Well, what also I found quite interesting is the duplexes that you have in New York and how that they're becoming more favorable because somebody can be upstairs, somebody can be downstairs because it's too.
Absolutely, yeah, absolutely, Stephanie. Interestingly enough, townhouses, which is only about, that only makes up about 3 to 4% of the New York City inventory. But townhouses, which prior to COVID really were not as popular because they're like 5 stories and you have to just use an elevator or go up 5 stories. And now because they're basically single family dwellings, became like very popular. And anything that has outdoor space, which was always popular, anything that in the city, outdoor space is valued immensely, but after COVID, it even became more important. So and as far as New York City, it's really a bargain now because I would tell you that prior to COVID, New York City was already at its peak. And they were at the highest, they were at their peak. And so besides for what it needed was a correction, now because it's New York City, you will see people going in and getting bargains. And so we signed a lot of leases in the last couple of weeks because people now feel this is a good time to trade up because you can get the space. So let's say you had 1,000 square feet. Space is very tough in New York. People live in small places. You could get the same space, maybe 1,600 for the same price. So you're seeing people trade up. You're seeing younger people who were priced out of the city and had to live in the outskirts, being able to come in and afford it. So I think it's gonna take a while. I think New York City will take 9/11. I lived through that, and 9/11 I think came back quicker, and then this will because 9/11 was not an economic financial burden. It was we were expecting a second terrorist attack and so people were just afraid, but they came back within about a year and then prices went off the wall. I don't see the same thing this time. I see that New York City, I'm looking at about 3 years at a minimum before it really comes back.
Thank you for that. And Ramsey, I'm conscious that you've got a question, but we've got to go to Mike Bristow first, across the pond. Mike Bristow, CEO, co-founder of crowdproperty.com, the UK's leading specialist property project online lending platform. I'm actually a client. Did you know that, Mike?
Yes. Yeah, that's great. Thank you.
How am I doing? Am I doing well? No, I don't know. I just leave it and just set it and forget.
Everyone's doing well.
Wonderful, of course. Londoners moved out of their homes in 2020 and moved into areas with lower housing costs. Actually, I also want to add that London rents were being negotiated down. So my tenant in my property in London actually requested a 10% discount. And I didn't understand what was going on because this never happens in London. And she got it based on, I can't remember how many housing stock was empty at the time. So London property investors remain attracted to the north of England and the Midlands with lower entry prices and higher rental yields, which is really your speciality. So what's your outlook for the UK residential real estate values, Mike? Is it better than New York? That's all I need to know.
I think I'm certainly not a New York expert like Dottie, but certainly have views on UK residential. And sort of our macro viewpoints on this, we, obviously the sort of a lot of the commentary is around the demand side for residential property and affordability, and we break that out obviously into segments, but also thinking about is there any sort of latency or pent-up demand. We've seen sort of historically low transaction volumes in the UK. Danger of averages caveat with all of this, right? I'm going to start with UK averages, and there's been a number of elements of uncertainty around the UK, the economic backdrop, political uncertainty, etc. And that's probably kept a level of uncertainty that hasn't led to runaway capital growth that we saw for 12 years leading into the 89-90 correction, for 12 years leading into the 07-08 correction. But we also, obviously, as a good LBS student, look at the supply dynamics of coming onto the market, building levels which dropped significantly. House building starts in 2020, and there's a 5-quarter lag on those to completion. So 2021 we'll see less new build property enter the market, and that's material, right? We're looking at 800,000 transactions a year in the UK. We should be building 300,000 new homes. The UK is spectacularly good at building 200,000, and we're probably going to put into market about 120,000 in 2021. So there's constrained supply. Then obviously the debt markets, with those historic transaction volumes being relatively low, 800,000 versus 1.2 million long-term average pre-GFC. We see a lot of capital competing for mortgage finance, both owner-occupier and investment mortgages, and that is reducing price as well as base rates on that supply of capital. And then a really sort of interesting view also on sort of current values. And the Daily Mail in the UK is very good at shouting about how property prices go up or down, or like to grab headlines. The reality is, in nominal terms, the UK on average is about 21% above 07 peak levels. But when you inflation adjust that, we're around about 16% below 07 levels in real terms. And that's a similar value to 2015, 2010, and 2004. So there's not a long run of capital growth that a shock can typically correct. So whilst our, we've seen 2 quarters of somewhat surprising growth in residential values, our house view, in my view, is slightly negative versus those current values, but nothing like the situation of 07, 08, where you had the compounding effects of very strong capital growth for many years, driven down by but base rates and mortgage rates and leverage. And then effectively a total stopping of the debt markets. The sort of the bellwether 95% loan to value owner occupier high street mortgage is not in the market at the moment. Okay, but 90% are coming back. This is a very different environment to 09 and 10. So look, I mean, residential is really where I have my expertise and our house expertise. And you know, fundamentally, people need to rest their head somewhere, and there could be a compression of yields. But investors, as you say, are looking for high yield regions outside of London. And what we see, interestingly, in the investor market is when I started investing in UK property in 2002, one could buy a flat, rent it out, wait 2 years, refinance, take out some capital and buy another one. It was too easy. And where it's easy and gains are evident, then competition comes in. And there's been a tightening of taxation and various different things in the long run. So you know, it's a very different environment now, but there are things that prop and can mitigate some of the demand side challenges that are clearly going to be faced in 2021.
Well, that's interesting. And you know that the rhetoric that the UK will be fine because it's an island and we're only running out of space. I'm just wondering how that applies to Singapore. And we have an Asia expert here, Karina. Prior to the MBA, she worked as an assistant vice president at Pacific Star Developments, one of Singapore's premier developers of prime residential and award-winning mixed-use projects. Singapore managed the COVID-19 pandemic well, but the economy is not doing well, and there seems to be a cash flow challenge amongst developers. What's going on in Singapore, and what are the yields according to your investment team?
I guess bad economies happen almost everywhere now, but Singapore started off with a weak economy to begin with. Like GDP growth was only 0.7% in 2019, which is the lowest growth rate since the global financial crisis. So when the pandemic hit, the recession was like unavoidable, and the pandemic also hit hard at the workers' community in Singapore, where most COVID cases happened last year. So this causes delay in construction schedules, which make project cash flow tight for many developers. On the other hand, the delay in new projects is actually good for existing buildings because there will be very limited new supply coming to the market. So the rental yield will not be too suppressed. As for the yield you asked, current net yield in residential property in Singapore is around 2%, which is very low. It's only a little higher than a mortgage rate of 1.5%. And for Singapore office, it's about 3 to 4% yield. Yeah.
That's a lot of data. Did you have to memorize that?
I guess I was an analyst.
Okay, well, that's really cool. I think from one analyst to another. Yasir, what's happening in the Middle East? We have Yasir Hamaduddin, Associate Investment Director in the Asset Management Division at Sidra Capital in Saudi Arabia, where I was born. He specializes in Sharia-compliant acquisitions. You acquired a large office campus in the US in the middle of a worldwide pandemic. Can you explain why? Some people are sitting on cash, some people are investing. How has COVID-19 changed your outlook on real estate?
Thank you, Steph. Starting with the second question, we looked at multiple sectors, we looked at many sectors, and two which really stood out for us were biotech and healthcare. And we set out to acquire assets with tenancy related to these two sectors. Fundamentally, these sectors, these tenants have outperformed during the pandemic. For example, labs, we've seen 100% collection, and lab work requires dedicated space. You can't simply work from home. So that's something that's set to continue. We also, what was also fundamental to us, apart from the tenancy, was the location. We looked at locations which we felt would perform well in a recessionary environment. Philadelphia, where the asset we acquired is located, to Arborcrest Corporate Campus, is a key biotech hub in the US and ranks number 4 amongst all, in Pennsylvania ranks number 4 amongst all states in the US in terms of National Institute of Health funding. What Philadelphia offers is a significantly lower cost of living and hiring skilled workers than other biotech hubs such as Boston and New York. The other thing that, just to reiterate, just to illustrate how vital Philadelphia is to the ecosystem, 80% of all US pharma and biotech companies have an office, maintain an office in Philadelphia. And with regards to the Middle East, it's a bit of a mixed bag, really. I mean, Jeddah, where I'm from, I know a lot of people have been sitting on cash waiting for prices to drop, and similar to how, what Mike said and Dottie as well, we've seen prices stabilizing and slowly begin rising.
It's interesting. And we have a lot of biotech expertise in the call this evening. We have Ian Dowson, actually. So we're going to go to a guest very quickly before we go back to Pooja. Ian Dowson.
So thank you, Steph.
Or not. Let's just see if
hello, I'm here.
We'll just do a moment here and then we can go to, yes, Ian. So I believe you have expertise in tech communities. How's this going to impact?
Yeah, but what seems to be happening, and it really was kicked off by a tweet by Elon Musk saying he was going to sell all of his Californian properties, that the tech community seems to be splintering from the traditional area of Silicon Valley, right? Heading towards the two most popular places are Austin, Texas, and Miami. And I often joke with my tech friends that, do they know that Miami is really under the sea level, and therefore in terms of climate change, right? Miami might not have a long future, but they don't seem to mind. What they see is the network moving there, and they follow the network. And I think that could be a trend evolving globally. Many of the Middle Eastern countries are now starting to develop properties specifically designed for the tech community. And one example was the Strip City on the Red Sea Gulf, announced by Saudi Arabia, which is going to be a 15-minute city. And I think that trend will be self-sustaining. The new cities, plus the splintering of the tech community globally.
Thank you very much for the contribution. Actually, that's important. And Dubai was considering smart city developments as well, I remember. Pooja, over to you.
Thank you, Steph. Now we will look at how we are financing deals. So this is for, this question is for Professor. You wrote a paper for the Financial Conduct Authority entitled When Discounted Rates End, the Cost of Taking Action in the Mortgage Market. What is happening in the UK mortgage market? Is it harder to get a mortgage now?
So, Yes, it's harder to get a mortgage now, but certainly not as hard as in the global recession. I think one important difference this time around relative to the financial crisis was that the governments, and when I say governments, I also mean monetary authorities, central banks, regulators. They took action across the board and decisive action, and they really brought out the bazookas. Okay? This was not really just a little bit of action here and there. No, it was the bazookas across the board. It was a reduction in interest rates. It was the quantitative easing, printing of money. It was mortgage payment holidays that also supported the incomes of those that had that outstanding. It was the furlough scheme that topped the income of people that had stopped working because of the pandemic. So there was support across the board. This definitely helped to stabilize the market, and the lenders also realized this. They realized that there is support from the government. And so if there is support from the government, banks are also not going to be as worried as they were during the global recession. Okay, so very high LTV mortgages are definitely difficult to get. Okay, that's certainly the case. We saw an effect is more difficult to obtain a loan, but it's certainly not what we saw during the crisis. And this goes back to what Mike was saying as well. He was making this point already earlier today.
Yeah, so that's very specific to the UK mortgage market. So I'll go to Dottie now to get some thoughts from her. So Dottie, in the New York Post, you said many more human buyers actually prefer duplexes. Why is that, and how are they financing them?
Well, in the US, the interest rate is at record lows. It's like 3%. It's hovering around 3%, which is really pretty much the lowest we've, kind of at the lowest point or close to the lowest point that we've been for a long time. So you've got great interest rates. Initially, again, the banks really were pretty good. I think they helped everyone out. It was not a problem getting financing. I think it will be tougher this year because I think people, what they did is people that rent, they don't have to pay their mortgage payments and they don't have to pay the landlords, and that's till May 1st. So you could be a landlord and you have a tenant that has a benefit, which is what they should have done, but they didn't do it for the landlord. So you have people that are in properties and haven't paid rent for almost 9 months, 10 months. And if you have a mortgage with a lender now, they're not going to foreclose on you. They'd have 100 million foreclosures and they don't want those houses. So I think everything is kind of back and they're not really taking action. They're working with people. They don't want to foreclose. And there's not that but what you are going to see this year, what we're seeing with mortgages and lenders is now they're a lot more careful on their lending because we don't know what will happen. As somebody just said, the government really put tremendous benefits to help everyone. And they didn't forgive any debt. They postponed you paying it. But in my opinion, at some point when people have to pay it back, most of them aren't going to even have the money. So the lenders are not sure how many, and people aren't allowed to get fired. So there might be, we don't really know how unemployment's going to shake out when you're allowed to get rid of people and we can't now. And we don't know how it's going to shake out. So I think they're going to be tougher now. They're going to start being tougher on your credit and your cash down than they were prior to this.
Right. And I think the same thing should be also true for the UK market, right, Professor? Because the unemployment is also, I keep seeing in news that the unemployment percentage is always increasing.
The big uncertainty, I think, in this dimension is to what extent the government support will continue, what shape will it take, for how long will it take? Of course, together with how long the pandemic will last, we don't know how long it will last, but then how large the government support will be going forward. And so that's certainly a big unknown. And in the case of the UK, there is also the other related issue that now seems like a minor issue, which is the Brexit. Okay, how will things evolve going forward? There's been a deal, but we've already heard in the news that some businesses are facing difficulties exporting. Is it due to the pandemic? Is it due to the red tape? What is it? So this is also an uncertainty going forward. So yes, I mean, there are certainly uncertainties in the shorter term. I think that in the longer term, for me, in the longer term, the big uncertainty related to the government is on the issue of property taxation, because all this spending that the government has been doing will have to be has to be financed. Part of it is through debt. Levels have been increasing. This will eventually have to be paid back or not. We don't know. Maybe not. Maybe it'll just stay high forever after. But if governments decide to raise capital, taxation is a source of raising capital for the governments, and the property is usually a good target for this, because it cannot be moved, it's immovable, it's tangible. So I think that's a big known also going forward, that I've been going forward more longer horizon.
That makes sense. Thank you, Professor, for that. And now, Steph, do you want to take it over?
Yeah, I have more questions for Mike, because it appears that it's harder to get a loan from you than it is to get into LBS. So you lent out over 100 million, funded over 1,000 homes, but you only accept 2.7 of all loan applications. So what, apart from some explanations there, why did you set up Crowd Property? Do you want to explain what it is?
So,
yeah, with your.
Sure. So we set up Crowd Property because partly post GFC, but also sort of medium run trends of banks, partly because of PRA restrictions and capital requirements, walked away from the property development market, and that left actually a big gap and a big pain for SME property developers in the UK, who are actually fundamental for supply of new build housing into the UK. Because look, you can't rely on large builders, because they need what is by definition almost a scarce resource of large parcels of land. SME entrepreneurial developers can turn small parcels of land, infill sites, etc., into housing, and that's fundamental for supply. At the end of the day, household growth is about 1.6% a year in the UK. The government often talk about the 300,000 supply need of new build real estate. We've not been near that for decades, just ongoing pains. And so we looked at that market, and having experienced that ourselves, and said, well, we'll build the best SME lender in the market. And that will be fundamentally tech enabled. But this is not tech for tech's sake. This is tech to brilliantly serve customers. And that is a real fundamental here, okay, of great tech underpins and enables a brilliant customer proposition. And so the two aspects of banks walking away from the market and also not being customer centric in their propositions, well, we thought, and to borrow the professor's term, this one of the terms why I enjoyed his lectures so much, we decided to bazooka the banks, and there was a clear need on the borrower side, and we saw the opportunity to bring democratized investment, which fundamentally is about matching the supply and demand of capital as efficiently as possible for the benefit of both of those stakeholders. You reduce the number of participants in the money flow chain, and there's less cost in the value chain, there's less profit being taken out of the value chain, and therefore borrowers, i.e. SME developers, benefit, and individuals who participate benefit as well. So, alternative finance and marketplace lending or similar, there are fundamental economic efficiencies why this will become a very, very large part of lending globally.
Yeah. But let's up the stakes. Tell us the yield that you managed to deliver for you. We have to start talking yields now to see who's going to win this out.
So it's property development lending. Okay, capital is at risk. Let's just be very clear about that. We're a senior debt lender, so first charge security on property development projects, and we have delivered an 8.52% average return to our investors. Lost no capital, lost no interest through 7 years of operating. And that's because fundamentally we put tech for efficiency and expertise for effectiveness of lending. And that model is catching on. And it's just the start of our mission to unlock SME developers in the UK.
Okay, 8.2. Suresh, have you got
8.52, just to...
5.2, sorry, me and my numbers. So now, Karina, I know that the residential assets provide a really good yield in Singapore. On one hand, we've got CNBC saying that offices are the top choice for Asia-Pacific property investors in 2021. But on the other hand, billion-dollar investment firms Allianz and KKR focus more on residential because the low occupancy cost is about 50 to 60% of that in Hong Kong. What is your view? Should we go residential or should we go commercial offices?
To start off, I think like Allianz and KKR's fund are actually diversified core portfolios that have commercial, residential, industrial, and other emerging alternatives. So I think they're not focusing on particular sector. But as for the yield, actually, office sector seems to provide a better yield. As mentioned, like net yield for office is around 3 to 4%, whereas residential is around 2%. But I think residential is a safer investment during the pandemic. Even though the return is very low for my taste, residential market in Singapore actually is quite resilient. From Q2 2020 onwards, transactions doubled that of previous quarter, and residential price also increased by 2% compared to last year, while GDP this year is last year, 2020, shrank by 5.8%, so minus 5.8%, while residential plus 2%. So you might ask why residential market in Singapore is so resilient. I think because Singapore government have been implementing cooling measures in the last 10 years to prevent speculation in residential market. So during that period, that 10-year period, average price of residential property rose of around 1.3%, which is in line with economic fundamentals, as GDP also increased at average 3.8% during the past 10 years. So with no price swing or asset bubble in the recent market cycle, there is limited downside risk during the pandemic. But on the other hand, now we talk about office sector. Office sector has been showing signs of higher vacancy and lower rental price during this pandemic. And actually what's more important is that the uncertainty of future demand going forward, because office sector, as we know, will definitely undergo fundamental transformation as work from home will outlive pandemic, of course. And businesses are downsizing their office space. So I would be cautious in investing in office during this time and maybe about 1 to 2 years after the pandemic. But that said, Singapore is positioning itself very well in terms of handling geopolitical power between US and China. It also working on transforming itself from a world's leading financial hub to a technology hub. So I believe Singapore economy will stay relevant for years to come, and that Singapore office sector will have strong demand in longer term. to sum up, my view is that even though office provides a better yield, but due to uncertainty in future demand, you might want to hold on investing in office now and maybe a couple years after the pandemic.
I don't know if anyone feels the way I feel right now, but can we give her a big round of applause for the research and the data and the preparation that you've taken into coming on today? That's extraordinary preparation. I'm really, really, really happy.
Oh, thank you.
Really happy. So that's
Thank you.
Thank you. Thank you for educating us. And that balances out the 2%. So yeah. So Yasir, I'm only pulling it. So Yasir, we have a problem here because this entire event was actually based on a rant that we were having about industrial, if you recall. And you were telling me industrials where it's at, this is what we need to do. So where do you see the value and which sectors would you keep away from? Bearing in mind, you need to beat 8.2. Thanks.
Okay, I'm going to try to be brief as possible, yeah? And I'm going to, industrial. I mean, honestly, industrial, we've got a couple of portfolios and we've seen 100% rent collection throughout. We've seen all the tenants in our portfolio being declared essential services, and every single without fail business was functioning normally. There were supply chain issues, but that's a separate issue. We've seen in the sector itself, very high occupancy, and the most interesting thing is we've been seeing cap rate compression in industrial over the last couple of years, but this seems to have accelerated during and after the pandemic. So that's sort of where I think that you can really generate a good and stable return. Another one would be an medical office building, rather, and I think.
Yeah, I think that.
Stephanie, can I jump in there and give some numbers? And I know you like numbers. I've got some numbers for you. Can I give some numbers there? Okay, so in the US, you can look at the real estate investment trusts, which are essentially property companies that specialize by sector. And at some point, I looked at the returns through 2020. So I calculated from January to October 2020, the returns of the different sectors. And Yasir will be pleased to know that industrial was a good performer with 8.51% return, positive return. It was beaten by data centers. Okay. Data centers beat industrial. The return on data centers was 22.61%. The worst performer was actually a sector that over this period was a sector that we haven't talked about yet, which is lodging resorts, minus 50% return. And the second worst was retail, minus 42%. Office, it was still negative, but better than retail. So this was just to give some numbers. Essentially, they corroborate what Yasir was saying, that industrial has proved resilient during the COVID crisis. Industrial logistics has proved resilient. Of course, residential has proved resilient. We already talked about that as well. Beaten only by data centers. So I'm not sure how many data centers there are in the Middle East, but I guess it must be hard given the climate to set up data centers in the Middle East and keep all the machines cold. But everything is possible there. We know that. So, sorry to jump in, Stephanie, but I thought it was appropriate to give Yasir some numbers.
Thank you very much, Professor. It's I tried to keep my response short, keeping in mind the time, but there's so much we can say on industrial. The very fact that, industrial, we can take geopolitics with the rise of nationalism and the desire to manufacture locally. And that's driving up industrial demand. You also have e-commerce. 1 square foot of retail space lost translates to 3 square feet of requirement in logistics and distribution. So those are all just key drivers of real estate, for industrial real estate.
Yasir, and what sort of yields are you looking at in industrial real estate?
Until the pandemic hit, we're looking at double-digit on portfolios of sort of mid-market tenants. And mind you, these are not investment-grade tenants, but the way you sort of manage the risk is by looking at assets which are mission-critical to their respective tenants, and the criticality of that specific tenant to their supply chain. Because I mean, I'll give you an example here. You've got airplane manufacturing, right? You've got Boeing manufacturing airplanes. They're the tier 1 supplier that supplies certain parts of Boeing aircraft, right? And a lot of these contracts are going to be sole source contracts, i.e. a single supplier for that part of the plane. That part doesn't get delivered, the plane doesn't get built. You go further down the supply chain, you've got more sole source suppliers. And remember, these have to be built to these parts. A simple screw has to be built to a very tight tolerance, and you can't just outsource that to any manufacturer, right? So when you go down to tier 2 or tier 3 suppliers, those are as critical as tier 1 suppliers. So this is again one of the things you look for when you're trying to achieve return on industrial.
We can't talk about tiers at the moment. Tiers are core. So anyway, we're at double digits here. So Yasir, I want you to think about, if you had 40 million, how would you invest it? This could be a question for all of us. And the professor is the only one who's exempt from delivering a yield, but he can give us guidance as to where to invest 40 million if he wishes. So
okay, do you want me to start?
No, I'm going to, you need to think about it more, actually, because Dottie,
I'm just thinking about it.
I'd like to know.
I grapple with this question every single day, because we've got at Sidra, we've got a huge amount of capital to deploy, and we're constantly bouncing ideas off each other, trying to find, where the best value is.
But what if it was your own money? Would you do the same?
Exactly the same on all of our industrial portfolios. I've got my family money invested, so it's.
I step back and tell everyone when I'm speaking that a majority of self-made millionaires made it through real estate and buying and investing in real estate. And if you look at when they invested, best time to invest is when no one's investing, and they say it's bad, and then you have to have the financial ability to hold it and be able to hold it, and that's really what I would say. I think real estate is always going to be a universal language, like everybody wants to hear about it. It doesn't matter whether it's 20 million, over those are more glamorous, but it doesn't matter whether you're 20 million or you can spend just a little bit. People all want real estate and want to know about it. So I think it's a pretty good investment if there's no liquidity. If you were able to buy at the low, and now I would say to everyone, my bet is on New York City that it will come back, and it will take a little bit longer than after 9/11, but it will come back. And I think right now, New York City is a bargain. So that to me is where I would be buying a lot of real estate. And then I would also be buying residential second homes, because the pandemic started a whole rage with second homes. People that had them immediately fled to them. And people that didn't have second homes rented just to get out of the city. And what's happened now is, I think across the country, you're going to see second homes, and they don't have to be ultra expensive. The way it's not going to be only for the ultra rich that have 2 or 3 or 4 homes. People that, are substantially okay, but not rich, will get second homes that are drivable, that can just get away from the big cities. So I would do that. I would do a lot in New York City, and I would do second homes in some of the resort areas and markets.
So the reason why I say 40 million as a figure is because a few years ago, when you were quoted saying, I couldn't be more proud of the company that Howard and I created. And that is when you sold your interest in Douglas Elliman for 40 million. I was going to ask you if you had any regrets and how did you invest it, but at some point I asked you.
I can comment on that. I would have not sold it, but unfortunately, when we did that partnership, I had an attorney that didn't really advise me properly, and I had a clause in my contract, which I really never looked at for the years, that said that that the Vector did not have to pay me until I died. So when I saw that, I thought I was seeing things. And to make a long story short, since they didn't have to buy me out, and they had a formula for the amount when I was dead. I took a much lower amount than I should have just to get some liquidity and some money out of the company because I had never taken $1 out. So I would have never done that had I not unfortunately found that clause that I signed, and I didn't even realize I signed it years ago. So, but at the same token, I'm an entrepreneur, and I'm still very involved with it and the company, and I am really, really working on doing real estate advising and things of that nature. I think it's another chapter for me, but Douglas Elliman will always be a chapter that's with me. Let's put it that way.
Some things just can't be sold.
Right.
So if you had 40 million today, how would you invest it? You said residential, second homes, and what sort of yield are we getting in New York City?
Well, I'm not really talking about the yield. I think you could get higher yields if you get different investments that are, look, I'm not a big, the stock market went crazy. People made tons of money during the pandemic. I didn't invest much because I haven't been lucky with the stock market, and I don't watch it myself. So I'm dependent on whoever is handling my money. So I don't want to compare it, but the returns there, you have more on the upside, but you also take big risks. So I advise people, it depends on your risk tolerance. It depends on your age. Like, if you're older, maybe you don't want to take the same amount of risk that you would when you're younger, because you can't take them back. But I do think real estate is at least in the US, if you can hold it, and if you look at anybody that got hurt, you can borrow money for almost free now. And you can leverage it. You can be borrowing money at such low rates that I think that's really a great investment now, as long as you can keep it. And I know that. So I'm a big believer of trying to invest what you know, or you really have very good advisors that you trust.
Okay. So, but we don't know the yields yet. We just know it's big. That's where we're going.
Well, it's big. It's safe, and I think it's fairly safer over time. I don't think it's the biggest yields. I mean, I think you can make more in the stock market if you watch it every day and you play with it. But you have to look at not only yields, you have to look at risks. So I think they kind of go together. So I think they're not the highest yields, but I think that they have less risk.
Karina, what have you learned about risk management during the pandemic?
Actually, I left the company not long ago after COVID happened, because I left the company in May 2020 to prepare for the MBA. So I didn't really go through the pandemic, but I can share some advice from my experience managing risk and from watching others. I think real estate development is difficult to change course during development process. So you have to get it right before start investing, and keep monitoring external risk and make critical decisions along key stages. During the planning stage, you have to maybe suppress the urge to go big. Some developer, they got cheap land, at very big cheap land, and just do it in one go. But I really advise against that, and try to develop in phases, and if possible, buy land in phases as well. And if the success of your project ties with the government infrastructure plan, you may want to make sure when the infrastructure project will complete with certainty, which is particularly crucial in developing country, where government may announce that they're gonna create this infrastructure project, but we see no end in sight when it's gonna complete. Also, once you purchase the land, think try to evaluate again if your investment context have changed. If there's a higher chance your project will not succeed, and sell it. You should sell it before develop. I know many developers actually make higher profit margin from selling land than developing themselves after assessing the new circumstances. Also, I think cash is king during construction. You should monitor your cash flow tightly during construction period, because this is usually where the largest budget variance occur. And the building actually does not have value until it's finished. So managing cash flow during construction period is very critical to your cash flow and the success of your project. And also you may want to have guts to cut your selling price to generate enough cash flow to complete the project and do it fast. Some developers are reluctant to cut their price because they're afraid they will lose existing customer, and they wait until it's too late. You know, when it's too late, when other surrounding projects have already cut their price and absorb all the demands until not much left for you when you started to do the same. And I think the last one would be always run scenario analysis. You prepare the fund for the worst case scenario, not the base case. And because real estate is a large long-term investment, so during the developing period, anything can happen, like a pandemic can happen. So having worst case scenario plan, you know where to tap your resources from when the downturn comes. I think these are the key takeaways from me when investing in a project to manage your risk.
Thank you very much for that, Karina. I think actually, Pooja, we're going to scrap the script and just go with the amazing questions that we have in the audience here. Whilst you read through and figure out who you're going to go with first, because it's just so epic, such a rich audience there. Suresh, do you think we could do the poll? Is this a good time to invest? Because some people are cautious, and so let's oh no, that's interesting. But let's do the other poll where we're asking, this is a live show, by the way. I don't know if anyone's noticed. So anything could happen here, and it does. So if we can create the other poll. Oh, I can create it. Okay, great. We're good. Shall I delete that? So a poll that says, is this a good time to invest? Yes or no? Just to see if we have an appetite for risk in this audience or not. If you can't,
the results were actually already shared for the same.
Okay, by the way, I need to apologize to everybody. I've got loads of direct messages and I'll read them as I can. Pooja, over to you.
Yeah, thank you, Steph. So we have our first question from Jay. Jay, I see you still there. Do you want to ask a question?
Yeah, sure. So I've been working with a PropTech angel group in USA, right? And there's a lot of exciting startups coming up in commercial real estate, for example, tenant engagement or air quality monitors or just marketplaces in general. So I wanted to know if you're seeing similar trends in your area, or if you're really excited by a particular sort of subfield in the PropTech area where you think a lot of innovation is happening or a lot of competition is happening that you feel is really changing the industry.
If I could jump in on that one, PropTech is a particular passion of mine. I sit on the investment committee of Pi Labs, the Europe's most prolific PropTech venture capital fund, and obviously it's built into the core of our business. It's fascinating. Look, we're talking about the world's largest asset class. We're talking about a fairly resource-intensive activity around the physical asset class. There's enormous sort of grassroots propositions coming out around construction tech, around asset management, around ESG in particular. So I've been looking at an amazing North American business around prioritizing carbon reduction investment for long-term IRR and enhancement to portfolios. It's such an exciting sector. And you know, I would, if that the 40 million question, I would diversify it across a number of places, and I would certainly be placing startup equity capital, growth stage equity capital into prop tech businesses. The upside is huge. The adoption levels have been slow, and that is quite typical of the sort of the incumbent real estate sector. I see it as sort of 6 or 7 years behind the sort of the fintech adoption. Whether it can be as large as that is a question mark. But really getting into this sector and really understanding the dimensions within it is super exciting. But there are some big questions about how to handle real estate efficiently, how to manage its carbon footprint, how to enhance occupier experience and differentiate, and how to manage supply and demand through marketplaces of every different usage type. So you know, watch the space, and it sounds like you are, and it's a very exciting space. It's worth. I'd also say it's worth doing some research into how the sector gets typified as well. The many different dimensions to it. So agency, marketplaces, construction tech, you know, fintech, prop tech overlaps, etc. Because that really helps. Getting a framework for it really helps you dig into where you think you have hypotheses on particular growth areas.
Good. Thank you, Mike. I have another question. Sorry, was anybody else raising anything? All right. So we have our next question from Jonathan. I see you with us, Jonathan. Do you want to raise it?
Yeah, sure. Thank you. And thank you everyone for organizing such a great event. So I'm in New York as well as Dodi, and we're seeing massive vacancies across the asset types here. I believe just office market alone, the amount of vacancies we have is actually more than the entire stock of office inventories in San Francisco. So my question is, are you seeing any operators or tenants that are taking this space, taking the risk and making the creative use of these spaces yet? Because I'm not personally seeing many people taking the risk, and they're just kind of waiting around for this pandemic to over. And as landlords, they're waiting around to kind of see the recovery again. So I'm just curious if across the globe, you're seeing any creative cases like this.
Are you talking New York City, or are you talking across the globe? Because I agree with you. In New York, I am on the board of governors for the Real Estate Board of New York. And so that's all the owners that own lots of property. And they're a very strong group, and they're very involved with New York City. And so they really work together. They helped us out of the last recession and 9/11. They're just getting together. They're looking at, they're trying to reconfigure space. They're thinking of putting in all the offices, the large buildings of COVID, actually physically put a COVID testing, because until people feel safe, they're not going to come back. You know, they're not going to come back in that way. And as far as and I think everyone across the board has looked at, you know, COVID and has realized they don't need the space they did. I just think that's kind of universal. So, you know, they either have to renegotiate or try to get out of leases. But when no one's paying money and everything's in a bad way, I think that right now, most people are trying to work things out rather than go to court. Because if you try to sue people, number one, the courts weren't even over. Number two, that's years and years and years. So I think they're doing the best they can to reconfigure it, make it feel safe so people, and we do think that even though it's differently, I mean, just like a lot of people left the city in March, as I said prior. So most of the people I know were not in the city, and now in September we started going back. But even no matter where you go and no matter how nice it is, I happen to be in Florida now. There's something about the city that I have never found anywhere else. That New York City has something, and for those of you who have lived there long enough to feel that, we have such a strong community that really we're going to do everything to bring it back. It might take a little bit longer, but I just think that's what's going to happen. I don't know about other places, but I do know nationally, it's the suburbs. I don't want to speak in generalities, but generally, most of the suburbs across the country for residential housing did well. And remember, the Generation X, which is they're probably in their early 30s, around that, so like 38, around there, 28. They're all having families, and that's the largest demographic that we have. And they are the largest percentage of people who are buying residential real estate, and that they outnumber the baby boomers. And that's also part of what you see. So we have low interest rates, a generation that believes in home ownership, that can buy with almost free money, the rates are so low, and are having children. They're at the age where they're having families. So I think that that's a pretty good bet. And I see you're going to see that trend as far as prices go up and down as long as you can hold it, And again, I wouldn't give advice across the board. You have to look at that local market that you're investing in. Oh, I love that song.
Thank you, Dottie.
Lovely music. Thank you, Dottie, and thank you, Jonathan, for the question. We have our next question from B. Gorski. I see B. Gorski in here. Are you still with us? All right. So the question is, and maybe it'll be of interest to a wider group, it is probably much more significant damage is being done in commercial real estate. All major city centers and large towers remain empty. Perhaps the effects are not fully felt yet. Should we expect to see headlines about major losses in those markets? I think this is a question which is recently answered, no? Or if somebody wants to shed more light on it, that's fine.
I can say a little bit about it. Just to offer one more thought on prop tech very briefly. There's a lot of cool stuff out there. I think where the sector needs to do a little bit more work, and I don't mean everyone, but some people is showing the bottom line, the impact on the bottom line. There are some pretty cool technologies happening, and people that are coming up with it are great. They're fantastic, and just a little bit more effort on an investment perspective, on a bottom line, on a cash, a more mundane point of view. But I completely agree with Mike that it's really option valued. If you manage to invest, and one of the 20 that you invest, it's big, it will be big. Okay, so it's a nice investment. In terms of the commercial real estate and the cities, I think that there are some interesting propositions developing out there, but we're probably not there yet. And there's also a big uncertainty as to how much office space will be needed in the future. Right? To what extent will there be a change in habits? I mean, how often am I going to go to the office? If I go to the office only 2 days a week instead of my usually 5 days, then companies are going to need half of the space, half of the office space. Maybe I'll share my office with a colleague, and I'm there from Monday to Wednesday, and my colleague is there Thursday and Friday. If we see this is a massive impact on the office space that is needed. Probably even worse will be the impact on the retail space. I'm sure that many of us have opened that Amazon account or have figured out how to order stuff online, and this will be a persistent change in habit. Okay, if we were not doing that before, we'll probably keep on doing now that we found how easy it is to do. So there's going to be an impact on the retail space that is needed. Okay? Where does this leave us? This leaves us with great opportunities, actually. Once the price is right, and there is opportunities for repositioning, for property repositioning, conversions, planning system permitting, which is a big problem in UK, there are going to be opportunities. So I think that the cities will come back. In what shape and form, and what sort of real estate will we have? It's another question. But yes, I mean, with crisis always comes opportunity, and I'm sure that this will be the same here. Just trying to figure out what is going to be needed, what is the space that is going to be needed going forward, essentially.
And I totally agree with that. It's very easy, I think, sort of to take the sort of the stats right now about commercial office space demand. And I personally believe, you know, when, for example, Twitter came out very early on in the global pandemic and said, we'll probably never have an office again. I think if that remains the case, in 20 years' time, we'll talk about that 300 character thing we used to do. Because fundamentally, okay, and this goes to Ian Dowson's point as well. You know, cities exist as knowledge centers, and humans share knowledge best when they're together. You know, we've all been productive and communicative over Zoom, okay, and if every business in the world was run by a Gantt chart, okay, we could deliver on those businesses, right? But true human innovation that requires sparking off each other, and especially in the disruptive and tech businesses, okay, will always be better with humans together. And so I agree. You know, Professor's view there is exactly right. It's what's the medium-term prospect. It's not what today's prospect is. The interesting thing is if there's a significant differential there, and there is a significant price differential in very bearish times, and people are being negative on it, that is an investment opportunity. But not for the faint-hearted, and not for those without great analytics behind it. The other perspective I'll just add briefly on I guess what we're talking about overall is real estate asset-backed investments. And look, you know, governments with significant debt mountains are going to be slightly more forgiving in their monetary policy around inflation. And so asset ownership that is exposed to real growth when debt stays at nominal growth will create value. Now there's a big caveat on that, right? You know, I'm not a macroeconomics professor, but the logic there is right, and it depends on beliefs and you know, going forward. But there is equity creation in the delta between real and nominal, and it depends on the servicing cost of that nominal. So you know, fundamentally, asset ownership, once you niche down into attractive segments, is a very good prospect moving forward.
That's a very interesting addition. Thank you, Mike, and thank you, Professor, for giving your input on that question. Moving forward, and now is all about vaccination. So our next question is around that. It is from Daud, and we want to ask, does the speed of vaccine distribution could make a big difference in properties prices between each stage or region in North America? So if maybe somebody who has more information, something from analytics about this vaccine can come up.
might even be an audience member who works in this sector, or we can move on to the next one. But if anyone is in the sector and would like to weigh in on that, it's your time to shine. And we move on, Pooja.
Yes. All right. The next question is from Craig Dingle, and it goes, does anyone see a problem with the obsolescence of the 30-year mortgage, a relic of the 1950s in a contemporary time when people shared jobs every 5 years? And if so, what solution come to mind?
I can say a little bit about that. I mean, the US has a long-term fixed rate mortgage, a nominal, which is nominal. There are not many countries around the world with such long-term fixed rate mortgages. But even though mortgages in the US are so long, they are refinanced fairly frequently. So it is not the case that the duration of the loan is so long as 30 years. Because of moving probability, refinancings that take place. So we should not think about the mortgage as being literally a 30-year fixed rate mortgage, because the probability of that being in place for 30 years is very low. Okay? So that's a few thoughts on that.
Just to add to that, people lived in a home for their whole lives. The baby boomers were the World War II group. So now, you know, the millennials, you have to look at a very different generation. And I guess you have to look into the future. And they're going to be different than the baby boomers. And they don't usually want to live in a place for 30 years anyway. So we've always had products, you know, in the US that, as you said, that would be good. I mean, I bought a home, my first home, when the interest rates were 16 or 17% here. And I got some, you know, I got an ARM, an adjustable rate mortgage that was like 11% or something. So financing is the US has multiple ways of financing, and you can even, if you have the good credit, probably buy something with very little down here.
So those are all very good comments. What I was referring to, and I should have articulated it better, is that one takes out a 30-year mortgage. One doesn't stay employed for 30 years. People find themselves laid off, or their job evaporates, or they leave a job for some other reason, and there are gaps between, and source savings is low. I mean, okay, for this COVID time, the savings rate has increased because people kind of been forced to stay at home. Setting that aside, saving rates are low, so people don't have emergency funds. They spend 3, 4, 5 years on a job, and then the job evaporates. They miss mortgage payments, therefore they get foreclosed on, such as in the Great Recession, or their credit becomes so bad that they can't refinance. And I see this problem rising, if not compounding, as people stay on the job fewer and fewer years, as we get more and more gig economy type participants. So I see the 30-year mortgage as being antiquated. And is there a product or a concept that addresses the contemporary workforce paradigm shift?
Okay, it's a very good question, Greg. I mean, there are products not out there that allow some flexibility. So meaning, for example, you can have a principal repayment holiday. There are some mortgages that you take, and then if you become unemployed or short of funds in a given year, you can approach the lender and say, I would like to take a repayment holiday. And for a period, you only pay interest, or sometimes you don't even pay anything. So there are products with this possibility. In Denmark, there are products with this. They have a long-dated mortgage, and you have opportunity to in 10 years take this payment holiday. I think that more innovative solutions like this will need to be introduced in the market to address precisely the type of job income profiles that we are observing these days, which are very different than the traditional model where you're employed with the same employer for many years. You have a very stable income, and it's very different in the gig economy, as Craig pointed out. So we'll have to design products that are suitable for those people. And this will also improve stability. It will improve stability, not only will benefit the people, will benefit the lenders, and it will improve macroeconomic stability because it will reduce the likelihood that people get into arrears with their mortgages and will have to default or be foreclosed upon. So I think, yes, I think it's an important point, very important point.
Thank you, Professor.
I don't see any more questions. If there's anybody who has more questions, then please go ahead.
Oh, I'm sure Akbar.
Hi. Apologies. Sorry there. I am sorry to interrupt you there, Stephanie. I like your glasses, by the way. Anyway, on to my question. I hear a lot about sort of New York and US property being, quite lucrative right now to invest in, which is fine. But what if you're a foreign investor? What if you're from outside the US? Do you find it would still be just as lucrative, or is it, if it's better that you're a resident of the US to really cash in? Because I would love to look at a place in New York and Miami. And I know I've been looking, but I'm not quite sure as a foreign investor how to go about it.
Yeah, well, you can, you are in my camp. I think the same thing. I think that's a great combination. You know, it's interesting that you brought that up because, New York had a lot of foreign investment and we haven't seen that in the pandemic, maybe because nobody could leave. And I think eventually people will kind of be able to virtually buy things. But I think at this point, most people still want to see it. So I'm glad to, if you need any information, I can help you with that and give you websites that have all different real estate companies or all different listings. But if you're talking about financing, then if you leave me a place to reach you, I will speak to some of the people that I have relationships with at the banks, since we do a lot of business outside there, and let you know. But if you are thinking of buying in New York and Miami, and those are really popular places and it's a great kind of diversity, then I tell you right now, Miami is getting higher because they had a glut before the pandemic of luxury condominiums because they kind of overbuilt that a bit. But now with the pandemic, people left the Northeast and went to Miami. So that's getting back to they're still under the value that they had at their peak, but that's coming back. And New York is certainly a bargain. So if you need anything, if you can share my email, and I'm glad to give you the information.
So Susan, if you want to invest in the United States, it's not going to be a problem because your collateral resides in the United States. And if you get a loan, of course, they're going to take a position on the collateral. The worst thing that might happen, and I don't even think this would happen, is they might require a higher down payment so that the lender feels fully secured. Whenever you sell the property, there will be about a 15% retainage of the sales price until, I believe, this is better addressed by a CPA, until you file your tax returns and then you get that back. And that's only because if you sell something and they don't withhold a little bit and you don't pay your taxes, they don't have any recourse because you're out of the country. But I would say, yeah, there are no barriers that I can see being out of the country and in investing. I don't know about New York, but I'm sure it's even more so than South Florida. But Miami is a very heavily international. I mean, a lot of European money comes into Miami. A lot of South American money, legitimate South American money, comes into Miami. So if that's something you want to do, I wouldn't allow being from outside the country to slow you.
It's nice. Thank you very much. Thank you.
All right. Any more questions we have? Taiwo, you have a question?
Yes, I do. I was just typing it. So good evening. Thanks for presenting. I have a question for Dottie, if it's possible. So I've heard a lot of comments in regards to property prices in New York and kind of in the typical kind of states. But I don't know if you had a view on, you know, the other kind of non-kind of common states like Texas in the South, in terms of kind of property prices there.
Yeah, I could give you a pretty big overview because I have offices in some other states, and also I do a radio show, so I talk about the national real estate market in the US, and then I talk about kind of the local or the Northeast market. Texas is you know, again, I don't want to generalize the whole state, but Texas is an up and coming, very up and coming and very hip, and you'll see Tennessee. There's places like you could even Google. I just did it on my radio show. I just can't remember them all. But like they'll say the top 10 cities of the future. Now, whether that really comes to fruition or not, but as we become more not as dependent, and I do agree that you have to go to the office for some interaction sometimes, but as more people can work with technology further from their hub, you're going to see that the hub doesn't have to be like a New York City the way it was. So some of these now hubs are up and coming for younger. You'll see the millennials' choices might be very different. I don't think it's the end of big cities at all, but I think that with technology and with the way we can communicate now, it allows people far more choices. And so I think in some of the Midwest things, you know, when you go to the coast, they're also expensive. So there's an affordability factor also that you'll see younger people going because it's too high in the cities. So I think that you could find, you know, but Houston and Texas are big. And so I have a lot of people that are going to Tennessee. There's a lot of good places. Now, whether they really, but you can get them cheaper. But I really don't know. And again, I don't think anybody knows. I think what you have to look at is down the road. It's like kind of buying something that's a brand name that you know is a brand and you know is always like if you buy a Gucci handbag, it's, you know, it could be 10 years old. You're going to have some value with it somewhere along the line. Whereas if you buy a no name, 10 years from now, it's probably worthless. So I think that when you buy prime properties in locations, it's almost like paying Monopoly. It's like a boardwalk or buying a Park Place. These are like brands, and people, especially foreigners, also pay more for brands. So that is why I'm so gung-ho. And it's not that I'm not gung-ho about investing elsewhere, but I think New York City is a brand name that you're investing in a brand. Now, when you are investing in a place that's up and coming, you might be paying a lot less, but you also, you know, there's no guarantees on that. So that's kind of what, you know, so little, but you take a lot less risk. And, you know, if you do your homework, and I can't speak on every single market, but if you do your homework and you look at the sales, if you look at the industries, if you look at the businesses, you could probably buy some very good investments for very little money down elsewhere.
Thank you. Thanks, Dottie.
Dottie, I have to say as well, you've been inspiring the female contingent in this community. I've been receiving lots of wonderful messages, and Taiwo actually runs events. So if you're happy to grace us with your presence again, I'm sure she'd love to have you.
Yeah, no, I was happy to be here. And I just want to say thank you for inviting me, because this panel, and I mean this, I always tell people the day you stop learning is the day you should just hang it up. I have learned a lot. This was an enlightening panel for me personally. This was really, you put together a great panel, and I'm just thrilled to be part of your company. And so, yes, thank you. I would.
Awesome. Do we have any more questions before we call on wrapping up?
I'm sorry to interrupt, but I was going to ask Ian Dawson about his, you know, if you could elaborate more about blockchain and the comment he left in the chat. Would that be okay, Ian?
There are very few examples that work on debt at the moment. However, a 30-year mortgage is such an inflexible financial instrument. And I think the benefits of the disintermediation aspects of blockchain and the fact that you can cross domains, i.e. you can incorporate the legal document, i.e. the mortgage, within a chain type technology, as well as the lending aspect, start to give individuals great flexibility regarding their own financial arrangements, that i.e. you can increase, you basically get a security that you can issue or modify in a financial market. And when you think about it, this could be a phase of disintermediation of what traditional financial markets do. Because at the moment, at every stage, somebody takes a cut and the consumer pays for that. The consumer of mortgages pays for that. There have been some tokenizations of very large real estate debt done by banks for very specific things. But I think over a 10-year period, somebody's going to come up with a model that may work here.
Thanks.
I mean, at some point, I do need the professor to come in and tell us all to just listen to him. And here's how to invest 40 million. But I don't know if the data's all in yet. We have 8.
One thing that I do like is residential, because of the risk return profile. Is not the highest yields, but it is low risk, and it's certainly something that many more institutional investors should have in their portfolios going forward. Some are taking action and putting, but so I like residential real estate. I have investments in residential real estate. I also like retail. Okay, retail with the right type of tenant in, or retail that can be converted into something else, where there's some flexibility, either converted into some residential. Now, why do all ground floors of buildings have to be retail in many countries around the world? This is the model. You have retail in the ground floor, and you also have a patio that belongs to the retail space. Actually, what people in residential are wanting these days is outside space. So why does retail have to be in the ground floor always? Why cannot residential be in the ground floor, right? So in apartment buildings, I'm thinking. So these are just a couple of ideas and in fact, I have some properties that resemble this profile in terms of family investments. So, okay.
And because the Portuguese market is actually very interesting, and it wouldn't be a show without mentioning that. Would you like to share insights from Portugal?
Portugal, the Portuguese market is fairly similar to other Southern European markets to some extent in terms of the structure of the market. So the residential real estate is not really an institutional investor asset class. It's dominated by the mom and pop owners that let the properties. I think institutional investors can do better than that. In the last few years, there's been a boom in prices in the cities, in Lisbon and Porto. Part of this was driven by the Airbnb. These questions around that going forward, and there's also questions about the tourism going forward, which is something that we haven't talked about yet, but. I'm quite positive. You know, if you ask me what I miss most during this pandemic is traveling to new places. Okay. If you ask me what I will do once there are vaccines, or there's or once it's allowed, or once there's some medication that is effective, is to visit new places. That means hotels. It means museums. It means so I'm quite positive on that sector as well. So another area where I would consider investing is at the right price, of course, is in this one.
And the right price is always key. I'm sure you have a framework in your elective that helps students navigate that successfully. How many students do we have who have actually had the pleasure of studying the real estate elective? How many have we got, roughly? Are they all new faces here, surely? Do you recognize any faces?
Of course I do. Of course I do. I recognize several faces, many names. Craig was just in my course that finished, Craig Tingle. So absolutely, you know.
Has he been graded yet? Sorry? Has he been graded yet? Have you?
Yes, the grade.
Yes,
the grade,
I was able to squeak out an A, just barely.
No, but it was a very good class, and an A is a very good grade, Craig. It was good because the course is also tough course. I'm not gently when it comes to the material covers. So anyway, my point is, if you come to study to top business school, you need to work hard for it. Okay. No pain, no learning. Okay, there is no learning without pain. Okay, that's a motto, if you want. Wow. But it's been great. Let me just say, it's been great, Stephanie. I really learned a lot today from everyone, from the questions, from the other panelists, and from your insights. And it's been really a pleasure and an honor. And I just want to congratulate you and the rest of the team for putting together the event and say thank you.
No, thank you. Thank you all, actually, in fact. Marta Grandenestal, our architect in EMBA-LJ 2021. I'm sure you have questions here that I'm always a fan of your witty retorts.
Hi, Steph. Hi, everyone. Thank you for the event. It's been really, really, really interesting and insightful. And the variety of opinions and ideas floating around I think it's been a very creative exercise of the whole community. Questions. Yeah, I mean, there was this question asked earlier, which I had in mind. It's kind of been partly answered. I'm very, very curious about the new trends on the creative exercise of conversions in city centers, right? All these opportunities that may arise in the UK by the change of law to ease the planning applications, changing the use for commercial to residential. But I mean, so my question, I know more about the UK, but but as I said, it's been asked before, like, are we seeing any specific experiments, successful experiments already starting or being done to really experiment with new typologies or combinations of what used to be full offices where retail on the ground floor could become, half of it residential with a co-working and, 10% of retail, which may change to multi-use or stuff like that, like, I think there's a scope to do that in the future. Not sure to what extent that's going to be financially providing the same returns, and I don't know when is that going to start. I don't know of any existing experiments being done. I was just wondering if anyone was aware of in other cities, perhaps, if it has started, or if everyone is just still wait and see. Not sure.
I think I can allude a little bit to this in the UK, and I think there is, as you recognise, significant relaxation of planning around commercial to residential conversions, and it needs to be done with caution. good master planning is about placemaking. And if you keep a heart to town centres and city centres, you retain that draw into that knowledge hub. And you cannot just rely, placemaking on the age-old knowledge centre. You need those draws, and those draws will shift. They will shift away from, maybe lower office demand, maybe less conventional retail, but really needs to be thought out a bit like how the evolution of shopping centres, how they've moved into destinations of entertainment and leisure. And that brings people together for purposes other than just shopping. And, that is how master planning needs to be approached. And I don't think that's just a UK thing. I think that's a global thing. It's a human nature thing. So, the question is, how does that work on the economics? So naturally, you'll get movement in real estate prices, and the arbitrage you can make from, say, underutilized office planning classifications and the upside potential into, say, resi conversions. It's that arbitrage of space value that will drive a lot of this, drive a lot of the entrepreneurial investment in those assets and changes of class. But one of the things that really needs to be unlocked and enabled by the ability to shift planning policy and planning designation fairly quickly. But I think some places are certainly taking this very seriously to keep that heart.
Thank you. Yeah.
Does anyone have any feelings? I know that pre-pandemic, I did a lot of research about smart cities and how people, where you could take space that wasn't necessarily the prime location space and have everything there, a park, babysitters, a school, a church, a bar, so you could go out, restaurants, and people would be really, and that was a very millennial thing. And that was a big push on that. And I was just wondering, anyone has any thoughts on if the pandemic would really hurt that, or people be afraid to live close to each other or next to each other? No.
But my opinion, I don't think so, because we are a tribe which flourish together. So it's just temporary. The distancing and everything else is extremely temporary, according to me. It may last until maybe a year or two, or depending on how the impact of this, the vaccine and the virus. But long term, like 5 years from now or 10 years from now, I still see that it'll be back to when pre-COVID era. That's how I see it personally.
Thank you.
Can I answer this?
Sure.
Yeah. Hi, Jyoti. Hi, Steph. I've seen people have moved out of center places and all, but there was a report on Financial Times recently, a couple of days back. People, those who have moved out of the city center, are actually missing the city life, and they have started getting bored. They're feeling, and they are low on life because they have and they are keenly interested in going back. So the lesser by the end of this couple of months, we believe that there will be more people coming towards the center, because the prices might go down for a bit, like the rental prices might go down for the bit in the center of London, but the more demand will catch up as soon as this COVID will go out. That's what I believe is going to happen.
I think most of us agree with you, Aris, and thank you for your input. I especially thank everybody today who was able to join, and for all the questions and all the inputs that was provided today. We'll give back 11 minutes to everybody else, and we'll wrap up the session now. I sincerely thank Mike, Professor Zhao, and Doti, Yasir, and Karina for joining in today and providing your brilliant input in the matter of real estate in this pandemic time. So thank you everyone for your time, and thank you all the participants for making this a successful event. Thank you.
Thank you, Mike.
Thank you.
Thank you. Great event.
Thank you,
Thanks,
everyone.
everybody.
Bye-bye.
Stay safe.
Thank you. Bye-bye.
Bye.
Can I ask one question to the presenter, Mike, if you are staying for 5 minutes?
Sure, yes.
Yeah. Actually, I'll just introduce you. We are making a startup for making automated valuation modeling of properties in collaboration with some universities. How do you see AVM market in properties going forward? Can I have?
It's a very good question. I think it's remarkably challenging in the UK market. I think it's easier in newer cities. You know, how does one build into the AVM whether you know, it's a Georgian terraced house in Chelsea, or it's the 60s building opposite that Georgian terraced house where a bomb landed. And you know, the reality is, well, you look at historical data on that individual asset, okay, but you don't necessarily have the churn. You don't necessarily have the sort of, you know, changing trends of demand. You know, for example, here, how would that AVM value today an increased value placed on buyers, or placed on outside space by buyers? You know, now it's a somewhat unfair example, because that is quite a one-off impact. But there, you know, there's definitely potential in this. There's definitely application in this. You know, let's take, for example, the ability for mortgage companies, both on residential, you know, owner-occupier and buy-to-let, to do a hands-off, you know, non-visited, automated valuation on a property to reduce mortgage cost friction, to enable more, you know, more rapid responses, and ultimately be able to deliver faster for your customers. There's value in that. The question is, can that be sufficiently accurate to, for example, stand up to a securitization of a mortgage book? So it's, I think it's incredibly interesting. I think that you have to look at, with all these things, you kind of have to look at data advantage. You know, you know, Zoopla, for example, have pretty good data advantage in these matters. Have they built the best AVM off it? I don't think so. Could they?
Bought over, sorry.
Could they? I think they could. I think they will improve that, you know, on an ongoing basis. The other question is, what's the best value capture of an AVM, right? Is it providing, you know, a SaaS product to mortgage lenders, or is it to drive, you know, algorithmic analytics in a real estate fund? You know, there are examples of both of those, and many more permutations on top of that as well. So hey, look, it's a fascinating challenge, and you know, but I mean, this is one of the areas where, you know, how does, for example, architectural integrity get valued? How does condition factors of an asset get valued? How does convenient proportions for human beings living in the space get factored in? You know, I've seen some shocking sort of end of development sales assets that you know you look at the comps and it's like, that's a bargain. You walk into this and it's like, you know, nobody would live there. So it's it's a fascinating challenge.
Thank you, Mike. We can chat sometime whenever you have time.
Yes.
So yeah, so we are trying to catch most of these dynamic conditions into the solution that's more of an AI, and yeah, it's an interesting space to be in.
Yeah, I think one of the an exciting application for that is certainly on the investment side. There are a few companies that are doing that, but it's then building in you know, more macro factors like infrastructure investment, transportation development, or those things. If you start overlaying those into forecasting sort of algorithms, spotting undervalued assets, and you know, there's interesting unique insight there. If it's right.
Yeah. So yeah, thanks a lot. I'll catch up with you sometime later whenever you have time.
Great question.
Thank you guys. Thanks, Steph, for organizing such a great, and all the team of yours. Great session. Thank you.
I don't know why I bother coming up with questions when the audience comes up with questions that are seriously beyond anything I could come up with. Were they tough? Were they tough, Mike? Were they a tough crowd?
Great questions.
Yeah.
Yeah, I mean that was a great group of people. Truly global reach, and fascinating questions, fascinating comments from the global perspectives. I mean, you know, I think I'd probably go to say this for any property real estate geek out there. It's, you know, it's a favorite topic, and wonderful to hear many different perspectives.
Mm-hmm. It's wonderful to see Arco Day here, and we've spoken before. Very ambitious young man, Arco Day. By his try today. I'm wondering, actually, Mike.
Yes.
I just had one question myself. Are you looking for a CFO, by the way?
Yes.
Okay.
Yeah, we did release that publicly. Yes. We wondered how well that would get picked up.
Yeah. So I nominate Suresh.
Right. Great.
So, but yeah, he's just a wonderful, wonderful human being, great work ethic, one of the smartest guy in my class. Is just, he'd be perfect. But anyway, so yeah, so thank you very much, Mike. I don't know what to say. I'm sort of in awe of everything and how we met, and now how this is my property portfolio. These are the pins.
Oh, brilliant. Brilliant. That's very cool.
Yeah. Anyway.
See, every property geek should have a map with pins.
Yeah. This house belongs to Douglas, who did the Mastermind 9 with me. Right. And who's in this chat, I believe, that Douglas Hedmonton there. And he did this, and he stuck it on the wall. I have one property there in a pin there because it's just out of area. Very small one. Anyway, we had a key system. Do you still love property, Mike?
Oh, yes. I haven't actually bought anything since 2016, I think, the last one. And it was a probably, you know, reasonable judgment at the time to say this isn't going to be fascinating for a few years. So we'll see how it plays out. So I'll pause, optimize portfolio, etc. Most of my stuff's in London. Some dotters, some in the southeast as well. A little bit international, which is just it's just one of those experiments that's worth doing, but never again. And now literally have no time, because every second is going into building crowd property, and hopefully you're seeing a bit of the output from that trajectory. So
I'm so happy that you came, and I'm so proud of your achievements.
Thank you.
And it's actually very inspiring, because there's a lot of entrepreneurial blood in the room. So in fact, MJ, the Kuwaiti real estate market is something that we were discussing, and how different it is to London. When he was here for December for the Managing Healthcare Elective, we were actually looking at a 20-bedroom HMO in sort of Marylebone, 18-bedroom maybe. And it was so interesting to see him apply the EMBA to working out the deal and the yield and what he should do, and should he sell it, should he chop it up. And it's cool. MJ, what do you think?
I mean, it is. I mean, the one of the main obstacles in Kuwait, I guess, is twofold. Number one, Kuwait is this big desert, and only 4% is used for anything other than drilling oil. So there's a limited space that people can utilize. Number two, we don't have mortgages. So you either have the cash to buy, or you just out of luck. And a meter of land here is about £3,000 a meter squared. So it's quite expensive.
Yeah.
And without any help somehow, it's impossible to buy. I mean, no matter how much money you make, unless like you're an entrepreneur and you hit it big, then it's going to be very hard to purchase in Kuwait. And that's why I thought maybe I would go elsewhere and venture to the United Kingdom. London is an international city, and hopefully it's always going to be in demand. I was going to say it is the financial hub pre-Brexit. I don't know how things are going to be post-Brexit, but I'm sure it's still going to be appealing, and hence it's a kind of a safe bet, if you catch my drift.
Yeah. So the thing I love, about and let's be clear, this is about individual asset residential investment. So exactly what similar to Stephanie, and it's about the competition in that space, and we know many of them between Steffi and I, and it's with no disrespect, it's not the most sophisticated market in the world, because there's a lot of perception of a get rich quick opportunity, and therefore you apply a good bit of EMBA and analytics and thinking and structuring and things like that, and you can stand out and differentiate, because a lot of the sort of if there are MBAs in real estate investment funds, they're not looking at the individual assets, and so you can find value, and equally walk away where it's getting outbid, and that's the interesting bit for me, is again, it's in sort of informational advantage or analytical advantage, and is the fundamental reason why I will never own shares on an exchange, because I hold zero informational advantage over the analysts.
Yeah.
And so it's just standout opportunity.
Whenever I say that, I get ridiculed.
Really?
But it's just not the same. It's just not the same. There's no. How can you? Where's the margin? I don't know. But One thing I've missed about hanging out in property circles is the decisiveness. And what I like about MJ, he's a surgeon. So he is decisive, he's kind of cut out, shall I say, for this trade. I'm trying to get him into this, you know, wonderful world of property.
So, I mean, Albana means the builder.
Oh
really? That's
And
brilliant. That's brilliant.
That boat is my grandfather's. So back in the days, in the summer, they would build houses, and in the winter, when it's raining, they cannot build. So they become carpenters. So he's a carpenter and a builder, but Albana means the builder.
That's brilliant. That's nominative determinism. There is a disproportionate number of people named after professions in those professions, and there's even a guy who plays tennis on the professional tour that's called Someone Tennis. You know, it's just hilarious.
Well, Webster's Weaver. So we're Thatchers and Weavers, and so you know, this could work.
How's the portfolio looking, Stephanie?
So it's fine actually. That's the data. It's, you know, Scottish property, high yields, but then I've sold two because the repair would have been 3 years of profit. So, you know, that's the only thing. But the yields are great. You know, I if it wasn't for the portfolio that I built on the mastermind, I would not have been able to comfortably move from Edinburgh to London and have all my rent paid and sort of really build my business well and not be forced to make decisions or compromises that were financially focused rather than ethos focused or whatever.
Brilliant. That's awesome.
Yeah, but I do miss introducing investors to do. I've lost all of that jus, and I miss that a lot. Hi, Jay.
Hey, I'm sorry. You guys are just talking about such amazing stuff. I could not leave. So
I know, but
yeah.
if people aren't really here, I'm sort of asking them to. So, Jay, are you in property?
Yeah, so I'm quite young. I just graduated last year from a bachelor's, and now I'll be joining London Business School. So I'm interning at a venture capital group. So I'm just helping them scan out PropTech related startups, and that's why I know so much about the American PropTech market, because I've just been looking at a lot of startups, talking to a lot of founders, and yeah, I just ventured into this new space and realized how interesting it is. So I'm not traditionally into property. I don't know a lot about the commercial or residential space, but I'm learning a lot. Yep.
Which VC fund is that, Jay?
So it's a group managed by Matt Knight. Zane Jeffer is a part, and Chris Munari. You might know some of them, but I'm not really sure. So a lot of big investors are a part of the group, and I just conduct research for them and help them scan out potential investments.
Very good. It's such a great space. I've been investing in PropTech businesses since about 2014. I think my first one was, and I'm not sure if Prop and Tech had been put together actually. Then I think it was still Property Technology. It hadn't got a phrase yet. So I'm in about 23 different PropTech businesses. I've had 3 failures from my portfolio, and a number that are going really well. One that's been invested in by Google. So it's a fascinating space. But as Zhao said, it's a hot topic, but it's got to start showing some bottom line.
Exactly.
At some point. And
Jay, is it true that people who have recently graduated are very keen to learn, inexpensive, and very helpful?
Yeah, that's definitely true. So I graduated in 2020, right at the peak of the pandemic, and everyone was doing was signing up on the Coursera courses or just seeking out information. And there's a lot of free information out there, right? And thankfully, a lot of information opened up. So people were really absorbing all of it, and there's a lot of learning that's been happening. Personally, I've grown a lot during the pandemic. So yeah, that's exactly right.
Yes, some of us have grown in more ways than one, unfortunately, but let's just talk about spiritual growth, I'm sure. But so how many out of your class, who are the smartest 5?
From my class, you're talking about
Four. I mean, help, you tell me. I mean, I don't know how many people that you would consider the smartest in your class. What do you reckon? 3, 13, what?
So only 2 rounds have been admitted right now, and we've not really been in touch that much. We've been on a couple of informal Zoom calls like this and made a WhatsApp group. So I'm joining in August. I'm joining LBS in August, right?
Oh, I thought you recently graduated.
No, I graduated from India from a bachelor's, and I'm going, yeah.
How exciting. Welcome to LBS.
Thank you very much. And this is like, if discussions like these keep happening, then it's going to be an amazing like 1 year, 2 year for me.
That's brilliant. And where are you now, Jay?
Yeah,
I'm currently in New Delhi, so I'm working remotely with the VC group, and yeah, hopefully shifting to London soon and starting my career there. So the reason I asked you the question earlier about PropTech 2 was because I don't know a lot about the European landscape. So I know there's a lot of companies coming up, but generally the US market is so far ahead from any other market. Maybe China comes close, India is growing a lot, but the European market I find is much more restricted or not as developed as the US in terms of innovation, or a lot of PropTech companies getting a lot of investments in general. So yeah, I'm quite excited to enter that space.
The Israeli market is very hot, especially around AI tech in prop tech. It's really interesting. They've got such great capabilities and talents there. UK is pretty advanced. Europe is lagging a lot. Although I think the stats on fundraised dollars per capita is highest in the Netherlands or something. Do you know Unisu, the sort of the global PropTech platform?
No, I'm not aware. Sorry.
So UNISSU. Okay, you will find absolutely everything and hundreds and hundreds of PropTech businesses on that platform. It's run by a guy called James Dearsley, who's one of the sort of the leading commentators on the sector globally. And you can spend days, weeks, months plowing through fascinating businesses. But it might be interesting reference points for what you're seeing. Where you are, and you can reference that globally as to what propositions are landing and getting traction in different markets.
Yep. I just went to the website. It looks really good, and that's exactly what I was coming to right? Like if the market really opens up for newcomers, for them to be able to absorb knowledge, and the startups also try, just networking well with other people, it would really help the market grow as soon as possible.
Yeah. Crucially, however, are you looking forward to England touring India in the cricket?
Yes. So India is currently on a big high. They just came off a win from Australia. So yeah, the spirits are quite high, and I look forward to it. How the players grow. There's a lot of new talent coming up, and yeah, England. You're not going to be quite happy with how the results turn out to be, but it's going to be fun.
India were absolutely brilliant in Australia, and and England are going to get absolutely killed in India because your team is absolutely brilliant at the moment. So
I agree with that.
That's a passion of mine. As is property and cricket. I'd be happy just on those two.
We should have our own chat then someday. That would be great.
Yeah. Good.
Jay, I think
guys, I'm gonna have to dash.
Let's call it a night. I've introduced you by email. I think Jay, if you can work as an apprentice for crowd property on some,
I would love it.
That would be great.
Brilliant.
Okay. Good evening.
Stephanie, thank you so much. Really great to see you. And yeah, let's do that somewhere.
Yes, absolutely.
Good stuff. Take care.
Bye.
Bye. Great talking to you all.
Great to meet you. Cheers. See you. Bye.
Bye.
How was it?